Good morning, everybody, or good afternoon, or good evening if you're watching this at a later time or somewhere across the world. It is episode number 9 of the Note Closers. We're excited. It is Monday, November 14th, isn't it? Wow. November is flying by. We're literally about 2 weeks out from Thanksgiving. 2 weeks out, roughly, from the Note Mastermind, which is exciting. Yay, the Magical Mastermind. Today's show, though, is probably going to drive a lot of questions. And as you see in the title, it's titled Pricing Expectations. And a lot of people always ask it, what should I bid? What should I bid on assets? What should I do? And with assets, we're talking about non-performing notes. It's not REOs, all right? So I wanted to go through that with you guys today, what the rough guideline is. Now, I get so tired. There's a lot of people that will bitch and moan, like on Bigger Pockets or Facebook, or, oh, pricing's gone up. And honestly, pricing has gone up a little bit. But you ultimately have the choice if you're looking at your ROI calculator, your spreadsheet on what the expected return is going to be, of whether to buy it or not buy it. That choice is yours, depending on your exit strategy, how good your team is, days on market, all sorts of variety of different things. So let's start with the first thing. When you're talking to a bank or an asset manager, one of the first questions should be, everything okay over there?
It's not showing you're on the feed, but it says it's live.
Okay, so what's pricing? What is color? Now, by color, it doesn't mean like orange or red or terror threat yellow or anything like that. What it means is kind of give me some idea as far as discount, okay? So, like, is it a 20% discount? Is it a 40% discount? When you ask what color is, that tells you what they're basically asking, what type of discount you're going to get, or the seller's looking for. Now, one thing to keep in mind, a lot of sellers, especially hedge funds, or I would say real brokers, will take a list, and their goal is to make as much as they can between what the bank is looking to sell it at, which the bank is giving them a flat rate across the board, between what you will buy it at on a one-off basis. Now, if you're only buying in one-offs and you're trying to buy really good assets, you're going to expect to pay a premium, especially if it's a great asset that's one of the tapes, top 25%. Now, what I mean by that is every hedge fund has a list, is going to basically categorize the assets down into 3 groups. One is the top 25%, where they expect the top 25% of the assets, approximately, that they'll make back most of their investment on that top 25. Okay? The second list is the middle 50. This is where they're going to make most of their profits. About half of the whole tape is where they're making profit on those sales. Now, the bottom chunk, they're just expecting probably to take a loss or break even on those because they're low-level assets. It's better for them to move those assets ASAP and be done with them. Sometimes they'll even take a loss, depending on what you're buying out of the other 2 pools, the other 2 chunks of that tranche. Okay? So keep that in mind. If you're buying just one-off, hey, expect to pay premium. It is what it is because you're cherry picking. Anytime you can buy some stuff and throw some junk in, you'll get a bigger discount for buying a mini tranche or a mini pool. Now, many people have heard me talk about the whole stair-step method. Stair-step method up. The higher the value of the asset, the higher percentage of that value you're going to pay. All right? And that's true. This is a guide, all right? Doesn't mean it's hard and fast. It's a guide. Some people get all bent out of shape. Oh, they came in at 49%. You said be 45. I'm like, really? Come on, man. I feel like Sunday NFL Countdown. Come on, man. So basically, if you're at assets that are worth $50,000 or greater, you should be expecting to pay 55% of the fair market value, not off of UPB. Okay, UPB stands for unpaid principal balance. All right. So as investors, what we are worried about today is fair market value. What's the asset worth today? Not ARV. If you're REO, fix and flipper, you're focused on what after repair value is. That's not what you want. You're buying the debt, you have to focus on as is value. All right, everybody? Now, as we said, $50,000 assets or greater, you better expect to pay 55% of fair market value. If the assets in the 40s, expect to pay somewhere around 45%. It's in the 30s, around 35. It's below $30,000 asset in fair market value numbers today, 25% of the value. That means $30,000 asset, you're probably paying $7,500 for. All right. Now, you want to make sure, too, you probably want to deduct taxes off of that. If it's a longer foreclosure state, deduct some of your foreclosure costs, especially like if it's in New Jersey or New York where the foreclosures can drag on for a period of time. If it's an occupied asset, especially in New Jersey, you're going to want to add on some foreclosure costs because they take you over a year to foreclose. Yes, New Jersey has expedited a fast foreclosure cycle. If it's a non-contested foreclosure, you can foreclose in 100 days. Same thing with Illinois. Florida's also instigated that. Still, they're not taking 100 days. They're still taking longer than 100 days. But that's if the borrower is willing to just non-contest it and walk away. You know, many of us have the exit strategy. We would prefer a loan modification, a reinstatement, some form of that forbearance agreement so that we don't have to put rehab costs in. We don't have to fork over a lot of foreclosure costs. We can literally keep the borrower in the asset, making a good return on investment. So keep that in mind with your pricing expectations. Now, if it's in a state like North Carolina, Arizona, Nevada, Texas, Georgia, where we have the fastest foreclosures, all right? Fast foreclosure states, you're going to have to add a little bit, 5, 10%. Maybe you'll be paying in the 60s, 65% of value of the note because of the fact that it's a fast foreclosure state. I mean, Texas, you can foreclose for about $1,000. Well, what's that mean for you? Well, it means you're foreclosing, evicting. You could be selling a Texas asset in 90 days, if not faster. What's that mean to you? Well, it means the velocity of capital is going to be faster. So hedge funds and banks are going to sell their assets in Texas 65, 70% of value, if not higher. Same thing, Georgia, like I said, North Carolina, you'll see that. Arizona, Nevada are hot states. Now, for you guys that are out in California, the land of fruits and nuts, actually it's just full of nuts now because all the water's dried up. All right, fruit's dried up. I'm just joking. Florida assets, banks are selling those at 80, 90% of value. It's stupid, does not make sense. Okay, I can tell you how many people I get to call me on a daily basis. Hey, we're looking for assets in California. I'm like, well, great, awesome. When I find that pot of gold at the end of the rainbow over there, I'll make sure and tell you where it's at. No, if I find anything, I'm keeping it for myself because I can sell it ridiculously fast. So, as I say, pricing expectations, it's expectations. Doesn't mean it's hard, fast rules. The more you buy, the cheaper you get in bulk. That's something to keep in mind as well. A lot of people get upset because the low-hanging fruit from the watermark exchanges, the FCI exchanges, note depots, a lot of people know those lists are out there, so the demand has gone up while the inventory's gone down a little bit in those places. Well, of course, normal economics are going to say price is going to go up. Now, it's the last quarter of the year, actually the last 6 weeks of the year. You really have about a month left of true note time to be reaching out to banks and asset managers directly. If you do that, you're going to get some assets sent to you that you can buy probably cheaper, okay? Depending on how the banks, what situation they're in, hurting, how much is on their books. If you're using Distress Pro, it's a great resource that Brett Palumbo's put together for you guys to be able to find what type of reserves a bank have and how much in bad debt that they have as well. So, as I say, your pricing expectations is an expectation. It all depends on the seller. What's their motivation as well to sell these assets? If you're dealing with a fund that's not hurting, that's in a really good place, hey, they can be picky. They may not want to sell it at a motivated price. Had a great conversation with my buddy Jack Krupe a couple weeks ago at PRP, and he's like, hey, we've got these assets for sale, but we're not hurting. We're going to sell these assets at 50, 60% of value. If not, if people don't like our price, we're just going to hold on to them and foreclose, which is completely sane. Oh my God, they would actually foreclose something out and make money on it? Of course they would. All right? What you have to do as a note investor is go out and find other resources. If you're upset with the pricing on firsts, hey, go out and start talking to more banks. Go out and find more hedge funds. Go out and talk to more servicers who represent small investors like you and me who have assets available for sale. Okay? Or if you're only buying in 1 or 2 states and you're not finding any product or inventory in that area, you know what you need to do? You probably need to branch out in other markets. Now, a few months ago, I wrote an article for Think Realty magazine called The Top 10 Markets for Note Investors. Hey, the grass is greener in those markets. Those included New Jersey, which is not one of my top 10, but it just turns out with the hardest hit funds and things available there. Hey, if you're a fix and flipper in those areas and you can find a note where the borrower has already left and is willing not to foreclose or not fight you in the foreclosure, hey, it makes sense. But you have Ohio, Michigan are 2 really hot states. Tennessee, Indiana, is a really exceptional state. So maybe you need to change the top 2 or 3 states you're buying in and move it over to some other market, and identify opportunities in those states that make sense for you. You know, Missouri is a great state as well because it's a pretty fast foreclosure state. There's a lot of opportunities out there for investors. You just have to tweak and adjust your business model. A lot of note investors have struggled with that the last couple of years of knowing how to adjust their business model to make sense. They come in looking at it like a fix and flipper, and they overpay. All right, or they don't do enough due diligence on the asset. They trust what the hedge fund or the seller says the value of the property is, and when they finally get around to it, it's actually not worth what the hedge fund was telling them it was worth. So you always need to put your eyes and ears on an asset. And by ears, you got to listen to your realtor. You got to have somebody in that local market drive by the property. You have somebody take a look at it, get out of their car, and tell you what the property looks like. Tell you what the neighborhood looks like. Because if you don't, you just trust some nationwide BPO company to pull numbers for you, they could really easily miss the hole in the back, the fact that the borrower was a hoarder, has got 40 bags of trash sitting in the backyard. What's another thing we've seen? Oh, somebody has the worst flea-infested house in all of Missouri or St. Louis. I've walked into one of those places before. So, guys, pricing expectations are just that. It's expectations for the third and final time. I'll tell you that. The stair-step guide is based off of fair market value. Once again, assets over $50,000 expect to be paying 55% of fair market value. In the 40s, 45%. In the 30s, 35%. Below $30,000, you expect to be paying $25,000. You're going to add to that number or adjust that number depending on the foreclosure time frame, taxes. All right. If the asset is if the bank or the hedge fund is taking the property or the note almost all the way to the foreclosure auction, great, congratulations. You don't have that expenses, but you're going to pay more for that asset. Probably 65, 70% of value because it's almost an REO. So you have to expect to pay REO pricing. For don't know what an REO is, that's real estate owned. Once a foreclosure is taking place, it's wiped out the asset. If you're in a 12-month foreclosure time frame and you're buying that note 60 days out of foreclosure, expect to pay a premium for it because all the work has been done. All right. Some other things that will influence pricing: crime. If you're in a bad area, crime area, you definitely want to take a look at that. Truly is a great place for the crime statistics and seeing what's going on around that. Another thing could just be gang violence. It could also be storms. If there has been a hurricane gone through, like New Orleans, Florida, been hit hard with a hurricane, that may withdraw your value or reduce your value some. Other things that can increase your value. Hey, if the market's going through the roof. Florida did that a few years back. There was assets that the hedge fund manager wanted 70%. I said no to, and I kicked myself because after a while, if I'd have bought assets at the 70% area in Miami Beach on the water, in 6 months I would have been at like 40% of value because the appreciation would have taken off. So these are some things to keep in mind. Pricing is always going to vary from market to market. That's why the stair-step model is a guide, everybody. Don't get your panties in a wad. Don't get all bent out of shape if the asset manager comes back and says, oh, they want more than a stair-step. Okay. Does the price that they want make sense for you with your ultimate exit strategies? All right. And that ultimately is up to you. What's your exit strategies? To modify, to reinstate, cash and keys, foreclose. I'm a big believer that you need to be figuring out at least 3 exit strategies. What's it going to look like if you modify? What's it going to look like if you have to foreclose? And then worst case, what's it going to look like if you've got to turn it into a rental? And as long as all 3 of those make sense, great. It's a good deal. If only you get one of them that makes sense, you better make sure that's your primary exit strategy and most likely to happen. Because if the other 2 don't make sense, don't do the deal, move on, or counter back. And you can always counter back. That's a beautiful thing with the note industry. It's okay to say, I don't like that. I don't like your $35,000 bid. I'm going to reduce it back to 30. All right? So keep that in mind, everybody. I want to thank you guys for joining us for episode number 9. We guys got a busy day. It's Monday.
Yeah.
We got a couple days before we have one of our fast track trains. We got about 8 investors coming in to spend a couple days with us here in Austin, Friday, Saturday, Sunday. Prior to that, Mastermind really kind of kicked their butt into gear. You guys are working on marketing today, assets. We got listed, and hopefully finally coming back in from Clay with some counters. and some other good stuff. So make sure, guys, if you like this, please share it. Definitely appreciate it. Make sure to share this to other people's pages. Ask questions, share topics of what you would like to see going forward, or any questions that we can answer here on the No Closer Show for you. Because this is all about you guys. Love the feedback, love the response, but start sharing or responding, or we're going to have to go a different route with this. So we'll see you tomorrow on episode 10 of the No Closer Show, everybody. Have a great day.